Welcome to another event of the Crypto and DLT Meetup of the University of Bayreuth. We are very happy today to have Maya Abu Said from the University of Bayreuth, who will present about cryptocurrency valuation and the stock-to-flow model. So in the last few years, the so-called stock-to-flow models, which actually come from precious metals, have increased in importance also for explaining the market capitalization of the prime price of Bitcoin. And we are very happy to have Jakob here as an expert to provide some insights into the stock-to-flow models for various different cryptocurrencies as Bitcoin, Ether, or also Decreed. Jakob, the stage is yours.
So I was doing an internship at the Bdvb headquarters in Munich. And I had some vacation days left and also overtime accumulated, and I was looking at my last 2 weeks, and I wanted to have a quiet last 2 weeks, networking with my future former co-workers. But then everything changed when my boss came around, looking to replicate this graph that you right now see. This is the original graph, the stock-to-flow graph that Plan B, or you find him on Twitter by the handle 100 trillion USD, posted, and which really popularized the model to the Bitcoin community. And what we see here is a time series. The colored dots, red to blue, are a time series of Bitcoin prices and Bitcoin stock-to-flow ratios. And in the upper right corner, you see gold and silver. So what this model suggested was that as Bitcoin would undergo the halving, that third halving that happened yesterday, at that time, the stock-to-flow ratio of Bitcoin would jump to 50, and this would also increase Bitcoin's value so much that price targets of 50 or 100,000 USD would be easily in range. And my quiet 2 weeks were gone. I had to research stock-to-flow ratios and replicate the whole model, put it into a graph, but I also got hooked. But what is stock-to-flow? Well, for the economists of you, money supply growth is a pretty well-known thing, and stock-to-flow is just 1 divided by money supply growth, or what's sometimes called monetary inflation. So, for example, if the ECB, or what we recently saw that the Federal Reserve creates a bunch of money, that expands the monetary base, and the growth, the percentage growth, that is money supply growth, and the inverse is just stock-to-flow. And the problem with this model, which looks amazing, to be honest, you see in the bottom right corner, the R2, if you're familiar with that, is very high, 100%, or 1 would be the highest that's possible, and also the coefficients are very significant, but we're not content with that model because it's a time series. It's a time series model. Okay, my presentation is lagging. No, it's a time series model. And the problem with time series models is that if you have two completely independent time series, what you see on the left-hand side, I generated two completely independent time series according to the equations I wrote down beneath truth. The blue one, I think the blue one is AR11. It's just generated by taking the value of yesterday, or t-1, and adding a random error. The same is done with 1, 2 with a different error. But if you regress the one on the other, you get the results you see in the black box. That's data output. You don't have to understand it if you're not familiar. I'm going to tell you. If you look at the lowermost rows, the two lowermost rows, you see astonishing results. If you get a t-value of that is farther from 0 than 3 in economics, you're generally very excited and go to your prof and say, "Oh, see, I found something very significant. Let's make a publication out of that." But in this case, as they are time series and have nothing to do with each other whatsoever, that's quite common because they are not stationary. What that means is not. It's important, but I can't go into it. So that's just for the people who know. Right, and if we want to test against that problem, against the spurious regression, there are ways, and mainly two. First, the English-Ranger test, which assumes that there is no co-integration. Co-integration is that the results, the good results of the regression, are not fake good results or coincidental, but that there is a real connection. And it assumes that there is no co-integration, and then tests whether and tries to disprove that assumption. And that is done by regressing. And if it was the case that the regression equation is true, or that there is actually a real connection between the variables, then the error term, which we can estimate, or actually the estimate of the error term is the residual. And then the residuals have to fluctuate around 0. That's the intuition of the English-Ranger test. I'm not going in too much into the Johansen test. That's just there to show you. It's kind of advanced math, and I took my sweet time to read up on it while writing my bachelor thesis as well. But it's doable, and it helps distinguish between spurious regressions, or regressions in which the time series don't have anything to do with each other, and regressions in which there is a true connection. Now, the stochastic flow model that can be published is, or it looks kind of good. We see on the left the fitted values versus the actual values of the entire Bitcoin market or Bitcoin network. So 100 billion is not the value of one Bitcoin, but of the whole network right now. And on the right-hand side, we see the residuals of the model. And now recall that if there is co-integration, then the residuals should revert back to 0, which is what we kind of see. There are some problems with this model, because even though the residuals seem to revert to 0, they stay away from 0 long enough for the formal tests not to indicate co-integration. That was a problem at the time when I wrote the thesis, because I believed the existing literature and thought there was co-integration, and that part of the thesis would be super easy, which it wasn't. But well, I think that's just science. So the problem is the normal stochastic flow model for the tests that would distinguish between spuriousness and a real co-integration relationship indicate that the formal structure flow model is invalid. Now, in my thesis, I went back to an older and more original definition of structure flow, such that the test actually turned out good. And I was kind of relieved, because then I could just continue with my thesis as planned, or more or less as planned. But lately, and I'm not, or my thesis actually is not is culpable for that. There is a debate on to what extent structure flow is a real non-stationary time series, because the definition of a non-stationary time, or no, of a integrated time series, is that without deterministic components, the time series has to be non-stationary. And the thing with Bitcoin structure flow is that the amount of Bitcoin generated by each block is deterministic. The protocol clearly states at block height 10, 50 Bitcoins are the block reward, and at block height 630,010 or something like that are we right now, because the halving was yesterday. The block reward is only 6.25, so that's not a random variable. And the stationarity debate that right now is ongoing really has to argue whether or not the timing of the halvings, or the timing of block discovery, makes structure flow non-deterministic enough for co-integration to be the sensible concept to look at. So that's kind of advanced econometrics, and I think a lot of Bitcoiners are kind of naysayers now, or they think the model is dead because it has too many problems. But for me, it's just an interesting debate that is still ongoing. Let's look at the options. I chose Bitcoin Cash as an altcoin because it's a fork that is its protocol is just like Bitcoin's protocol, with very kind of minor tweaks. So if structure flow works for Bitcoin, which might still be the case, then it should work for Bitcoin Cash too, if the reason for structure flow to work is in the protocol. So I tried to get a sense of why the structure flow model works, or why structure flow would drive Bitcoin's value, and chose the contenders based on that. Now, Decred uses a different protocol, but really tries to sell itself as hard money, as reliable payments, and that should be also an indicator that structure flow works, because if something is seen as hard money, then the harder it is, the higher the structure flow ratio is, the more people should value it. And the third contender is Ethereum, which I chose to have really high variation in the sample, so to say, because Ethereum was never intended as hard money. Vitalik, or the founder of Ethereum, Vitalik intended Ethereum as a computing platform, not as hard money. So as people don't see it as hard money, Also the stock to flow relation shouldn't be there. The relation between stock to flow and market cap. And the results are that for the altcoins, it's not as debatable as in the case of Bitcoin. In the case of Bitcoin, there are pro and con arguments, and the model looks like kind of on the edge. We're not sure whether or not hardness or the SF ratio drives price. Whereas for the altcoins, it's clearly not the case. I'm not going to go into the small points. I guess you've read them by now already, and go on to the pictures. And what we can see here is, again, the Bitcoin stock to flow model in the upper left corner, and as a comparison, all the other models, and you really see the time series of the altcoins and stock to flow and the estimated stuff, the estimated value based on the stock to flow model really diverge. It's much more similar to the spurious case that I showed earlier than to the Bitcoin case. So I think we don't really need to understand, or we don't really need to understand the intricacies of an Engel-Granger or Johansson test to see that really for the altcoins, it's much harder to make the case that stock to flow drives the value. And with that, equipped with that finding, I discussed in my thesis also why why it actually couldn't be the case that for more than one asset, the stock to flow ratio drives price. Because imagine a world in which stock to flow alone was necessary to give anything value. Then obviously we would just produce a lot more Bitcoins or Decreds, a lot more protocols that have individually a high stock to flow ratio and thus are valued by the market. And then you have a million altcoins with, or a million cryptocurrencies with a very high value. That's obviously counterintuitive, but much rather it should be the case that agents seeking to maximize the hardness of their investment or the stock to flow ratio of their investment just choose the one with the most believable monetary policy, or choose a combination of most believable monetary policy on the one hand and high stock to flow ratio on the other hand. And Decred actually, as I told you, tries to monetize on the hard money, property, on the hardness property of money this way. And you can see in this chart, which I robbed from a Medium article, you can see the link, I hope, that Bitcoin started in 2009 and the total supply logarithmically approaches 21 million, whereas Decred started in 2016 and takes a fast track to 21 million. They have a higher block reward that also, but they're also hard capped at 21 million. So Decred's stock to flow ratio should at some point overtake Bitcoin's. And an interesting thought experiment is now, what if Bitcoin and Decred had started at the same time? If we imagine hardness maximizing agents under the restriction of a believable monetary policy, what would they do at this at the time when Bitcoin and Decred start and it's time to invest. Well, while Decred is faster in delivering hard money, it also started with a pre-mine. Does everybody know what a pre-mine is? Can you think? Can you do anything to? No. Okay, so I'll just explain it. When Decred started, the developing team got 8% of the ever available supply of Decred as a compensation for programming it. And at the same time, Decred uses a proof of stake system to settle conflicts within the community. That is, there is a platform, and you have to prove to the platform that you own a certain amount of Decred, and then you get voting tickets in proportion to that. And for our hardness maximizing agents, that is actually a con, because the developer team, which is a small group that knows each other and can act coordinated in a coordinated way, owns a lot of the coins that are available at the start. So they would much rather choose Bitcoin, where no central authority has a lot of power, because everybody who runs a full node can decide whether or not to run it on a specific version of the Bitcoin protocol. So even if they started at the same time, that pre-mine centralizes power and makes it unattractive for people who much rather like a static or very dependable monetary policy. And that's actually a point that you hear quite often in the Bitcoin community, if it's about altcoins, that they say, yeah, well, I don't know, Ethereum mostly runs on Amazon web servers, web services servers, so they're not decentralized, and thus they are not very robust to attacks. And the same argument also applies to Bitcoin Cash, because they increase the block size. That is, they increase the amount of transactions that can be processed within one block, which unfortunately also increases the size of the blockchain, which makes the equipment to mine or even to verify blocks yourself much more expensive, and thus promotes centralization of the Bitcoin Cash blockchain. So Bitcoiners seem to be very decentralization conscious. So so what I'm kind of concluding in my thesis, what I'm concluding right now, that the debate has gone on after my thesis, is that the stock-to-flow model is really scrutinized, and it is not dead already, but it's far from law. I'm not advising you to buy Bitcoin right now, because it has the same stock-to-flow as gold and will soon have the same market cap or anything like that. But it's a really interesting debate. It's going deep into why cryptocurrencies have value, what's attractive about them, and it really shows that different coins have different value propositions. As Bitcoin, for example, now has much more, or caters much more to the store of value, hardness taste, whereas Ethereum is an ecosystem full of innovative new stuff. So that's really interesting to follow. And if you do want to keep up, follow Plan B. He is 100% in USD on Twitter. Bitcoinometrics. I didn't talk about Nick in this talk, but he is really important. He has been very important to the debate because he was the first to introduce the notion of co-integration. Then my boss Manuel at ByNLB is also on Twitter, and we found the guy who implemented the Ardo package, or yeah, it's not important. He's he's an expert in time series econometrics. Sebastian Kripgans of I don't know, some university in Britain. And I think if you follow these four, you will be up to date at all time. So that was my part, and please ask me away.